Picture a gleaming tower of glass and steel in the heart of a global city. Inside it sit institutional portfolios worth hundreds of billions, pension funds, sovereign wealth vehicles, real estate investment trusts. The buildings generate rent, the numbers look solid on paper. Yet when an allocator needs to free capital to rebalance, to meet redemptions, or simply to seize a better opportunity, the exit door is narrow and expensive. Selling a large commercial interest the traditional way can take months. Buyers demand steep discounts. Capital stays trapped while higher-yielding uses of money pass by. This is the classic real estate liquidity trap. In 2026, a quieter experiment is underway. Some global trusts and specialized platforms are converting pieces of that physical ownership into digital tokens. The promise is fractionalization, faster secondary trading, and new ways to unlock value without a forced fire sale of the underlying property. Tonight, we examine what is actually happening, not the headlines that claim the trap is already solved, but the measured progress, the remaining limits, and the realistic path ahead. You are watching the Signal and Noise podcast. Make sure to like and subscribe as we analyze with no emotions or bias, just raw data analysis, pointing towards the signal and dispelling the noise. This is not financial advice. Do your own research. Let's get into it. Commercial real estate and private real estate funds have always lived with a fundamental tension. The assets are large, long-term, and location-specific. Publicly listed REITs solved part of the problem decades ago. Their shares trade daily on stock exchanges with tight spreads and deep volume. An institution can sell millions of dollars of a major REIT in minutes during market hours. The deeper trap sits in the private and direct ownership layer. The single trophy assets, the closed-end funds, the limited partnership interests that still dominate many institutional portfolios. Secondary markets for these interests have long been thin. Finding a qualified buyer can take 30 to 90 days or longer, often at a 5 to 15% discount to net asset value. Higher interest rates in recent years widened the valuation gap for some property types, particularly office. Maturity walls and refinancing pressure remain real for leveraged assets. Liquidity indices have shown periods of improvement followed by renewed caution. Capital is not completely paralyzed, and debt markets in 2026 have shown renewed competition. But the ability to exit large private positions quickly and cleanly is still constrained. The opportunity cost is measurable. While capital sits locked, other asset classes, technology infrastructure, certain credit strategies, liquid public markets continue to offer more flexible entry and exit. The question for trustees is whether a new technology layer can meaningfully widen that exit door without destroying the long-term nature of the asset. Tokenization begins with a legal wrapper. A special purpose vehicle or trust holds title to the property or portfolio. Digital tokens are then issued that represent shares or beneficial interests in that vehicle. A $500 million skyscraper is not literally broken into physical pieces. It is divided into millions of programmable claims. Smart contracts handle distribution of income, enforce transfer restrictions, and can embed automated compliance checks. Only wallets that have passed KYC and accreditation filters can hold or trade the tokens. Layer 2 networks and specialized chains reduce costs and increase speed for these operations. In practice, the market remains early. As of mid to late 2026, verified on-chain distributed value for tokenized real estate sites in the low hundreds of millions of dollars across a few dozen platforms and roughly 100 assets. Platforms such as Rental, Groma, RedSwan, Realty, and others have tokenized residential and commercial interests, but the scale is still modest relative to the multi-trillion-dollar global real estate market. Public REITs continue to provide far superior day-to-day liquidity. Tokenization's primary contribution so far is improving access and secondary market options for assets that previously had almost none. Traditional commercial sales can stretch across 6 months of due diligence, negotiation, and closing. Tokenized interests where active secondary venues exist can transfer in minutes or hours. Yet the depth of that market is still limited. Trading volumes on most platforms remain thin. Bid-ask spreads are wider than public equities. Many tokens trade primarily on the issuing platform's own marketplace or on regulated alternative trading systems rather than deep, open, automated market makers. Cross-border trading faces ongoing legal, tax, and securities law friction. There is no universal 2026 breakthrough that has removed all barriers. Regulatory progress is real, but jurisdiction-specific. Dubai has linked certain tokens to its land registry. The United States continues to treat most offerings under existing securities exemptions. Europe routes many structures through MiFID II. The result is a patchwork of improving but still constrained secondary markets. The improvement is incremental, faster matching and lower minimum ticket sizes for assets that once required lengthy private negotiations. One of the more practical near-term uses is the ability to post tokenized interests as collateral. In theory, an owner can borrow against a real estate token without selling the underlying stake. In practice, the largest and most accepted real-world asset collateral in DeFi today consists of tokenized treasuries and certain credit products rather than pure real estate tokens. The shift toward treating high-quality property tokens as near-liquid reserves is still nascent. Where it works, the liquidity trap is partially eased. Capital can be unlocked through borrowing rather than forced sale. The risks, smart contract vulnerability, oracle accuracy, legal enforceability of the token, and liquidation cascades remain material and must be managed with rigor. Looking ahead, the most credible trajectory is not that the world's largest trusts become fully liquid-first entities within 24 months. Progress will continue to be selective. Tokenization is likely to expand most rapidly in private funds, single-asset vehicles, and markets with supportive land registry and securities frameworks. It can narrow access barriers for smaller investors on certain retail-oriented platforms, giving them fractional exposure to properties previously reserved for large institutions. Yet the bulk of institutional capital will continue to use public REITs for true daily liquidity and will adopt tokenization where it improves secondary markets or operational efficiency. What we are watching is the careful construction of a parallel rail, one that makes certain real estate interests more divisible, more transferable, and more composable with digital finance. The buildings still stand in the physical world. The claims on them are beginning to move at the speed of the chain. Ownership is becoming programmable. If this measured look at real estate tokenization was useful, subscribe. This is Signal and Noise. Stay clear-eyed.